Silver just hit $82 per ounce, up 155% in 12 months. And if you think this is just another bull market, you're missing the pattern. In 1980, silver exploded from $6 to $50 per ounce in less than a year, then crashed 80% in 4 days. The Hunt brothers tried to corner the silver market, created the biggest precious metals bubble in history, and destroyed fortunes when it collapsed. Today, in 2026, silver is following the exact same pattern. The same inflation crisis, the same dollar collapse, the same speculation frenzy. History is repeating. But before I reveal whether silver is heading to $175 or crashing back to $40, and exactly what you should do with your silver investments right now, let me show you the 3 eerie parallels between the 1980s silver bubble and today's surge that nobody is connecting. Welcome to Financial History Decoded, where we use financial history to understand what's happening right now. I am going to show you why the current silver price surge to $82 per ounce is following the exact playbook of the 1979 to 1980 silver bubble. And I'm going to prove it with historical data that predicts what happens next, because those who don't study financial history are doomed to repeat it. And right now, silver investors are repeating the mistakes of 1980. Let me start with what's happening right now in 2026. Silver prices have exploded from $32 per ounce in February 2025 to $82 per ounce today. That's a 155% gain in 12 months. Investment demand is surging. Dealers are reporting record sales. Online forums are filled with silver bulls predicting $175 silver. FOMO, fear of missing out, is everywhere. And the narrative driving this surge is identical to 1980. Inflation is out of control. The dollar is collapsing. The government is debasing the currency. Silver is real money. You need to own physical silver to protect your wealth. This is the exact same story that drove silver from $6 to $50 in 1980. And it ended in catastrophe. Let me show you what actually happened in the late 1970s. In 1979, the United States was experiencing high inflation, over 13% annually, combined with economic stagnation and rising unemployment. The dollar was losing value rapidly. Oil prices had quadrupled due to OPEC supply restrictions. Interest rates were climbing, consumer confidence was collapsing. Paul Volcker had just become Federal Reserve Chairman with a mandate to break inflation at any cost. This economic chaos created the perfect environment for precious metals speculation. Gold and silver were seen as the only safe havens from dollar destruction. Sound familiar? This is exactly the narrative driving silver today in 2026. Now let me introduce you to the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt were Texas billionaires from an oil fortune. In 1973, they started accumulating physical silver, not as investment, as a strategic position to corner the market. By 1979, the Hunt brothers and their associates controlled an estimated 129 million ounces of physical silver, plus another 90 million ounces in futures contracts. That was roughly 50% of the entire world's deliverable silver supply outside government stockpiles. They had cornered the market. And when you control supply, while demand is exploding, you control the price. Here's how the squeeze worked. The Hunts would buy silver futures contracts. Then they would take physical delivery instead of rolling the contracts forward. This removed silver from the available supply. As supply tightened, prices rose. Rising prices attracted more speculators who bought futures. The Hunts took delivery of those contracts to a feedback loop. By January 1980, silver hit $50 per ounce, up from $6 18 months earlier. An 833% gain. The Hunt brothers' silver position was worth over $4.5 billion. They had pulled off the greatest commodity corner in modern history. But here's what happened next. The COMEX and CBOT exchanges, where silver futures traded, changed the rules in January 19. They implemented new position limits, restricting how many contracts a single entity could hold. They raised margin requirements. forcing speculators to put up more cash to maintain positions. And they created a liquidation-only rule prohibiting new purchases. Only sales were allowed. This was designed specifically to break the Hunt brothers' corner. And it worked. Silver peaked at $50.35 on January 21st, 1980. By March 27th, silver had crashed to $10.80, an 80% decline in 65 days. The Hunt brothers lost over $2 billion. They declared bankruptcy. The speculation bubble had popped. Now let me show you the three eerie parallels between 1980 and today. Parallel number 1, the inflation narrative. In 1980, inflation was running at 13.5% annually. Today, in 2026, official CPI shows 7.2%, but real inflation using 1980 methodology is over 15%. Food prices, energy costs, housing expenses, all surging. The dollar has lost significant purchasing power. This creates the exact same psychological environment, where people flee paper currency for hard assets. The inflation fear is identical. Parallel number 2, dollar weakness. In 1980, the dollar was collapsing against gold and foreign currencies due to expanding federal deficits and loose monetary policy. Today, the dollar index has fallen from 108 in 2022 to 93 in 2026. Budget deficits are running at $2 trillion annually. The federal debt exceeds $36 trillion. Foreign central banks are reducing dollar reserve holdings. China and Russia are trading in yuan and rubles, bypassing dollars. The dollar weakness is identical. Parallel number 3, speculation, frenzy, and supply deficit narrative. In 1980, silver bulls claimed industrial demand from photography and electronics would create permanent supply deficits. Today, silver bulls claim industrial demand from solar panels and electric vehicles will create permanent deficits. In 1980, investors hoarded physical silver, removing it from the market. Today, investors are buying physical silver at record rates. Dealers report shortages, premiums over spot price have exploded. The speculation psychology is identical. But here's what the bulls miss. The silver supply deficit narrative was wrong in 1980 and it's questionable today. When silver hit $50 in 1980, industrial users found substitutes. Photography companies reduced silver content in film. Electronics manufacturers switched to alternative materials. High prices destroyed industrial demand. Meanwhile, high prices brought new supply. Old silverware was melted, mining production increased. Government stockpiles were sold. Within months, the supposed deficit became a massive surplus. Supply and demand are not static. They respond to price. This is basic economics. Today, the same dynamics apply. Silver at $82 makes substitution economically attractive. Solar panel manufacturers are already testing copper alternatives. Electric vehicle producers can adjust battery chemistry. And high prices will bring new supply. Recycling becomes profitable. Marginal mines restart production. If silver sustains above $80, within 12 months, you'll see significant demand destruction and supply increases. The deficit narrative collapses. Now, let me show you the market structure risk that nobody is discussing. In 1980, the Hunt brothers controlled silver through a combination of physical holdings and futures leverage. Today, we don't have a single dominant player like the Hunts, but we have something potentially more dangerous. We have millions of retail investors concentrated in the same trade simultaneously through social media coordination. Reddit forums, Twitter financial influencers, YouTube silver channels, all amplifying the same narrative. By physical silver, the price is going to the moon. Don't sell, hold forever. This creates a crowded trade where everyone is positioned the same direction, and crowded trades end badly when the narrative breaks. Here's what triggers the reversal. In 1980, it was exchange rule changes that forced liquidation. Today, several catalysts could trigger silver's collapse. First, Federal Reserve pivot. If the Fed successfully brings inflation down through aggressive interest rate policy, the inflation narrative breaks. Silver loses its appeal as inflation hedge. Second, dollar strength. If economic crisis in Europe or China drives flight to dollar safety, the dollar strengthens and silver falls. Third, industrial demand disappointment. If solar panel installation growth slows or electric vehicle adoption plateaus, the supply deficit narrative breaks. Fourth, and most dangerous, leveraged liquidation cascade. Many silver investors are using margin and leverage. If silver drops 15 to 20%, triggering margin calls, forced selling creates cascade. Let me show you the warning signs that we're near a top. First, mainstream media coverage. When CNBC, Bloomberg, and the Wall Street Journal start running frequent silver stories, that's a contrary indicator. Mainstream coverage arrives late, after the smart money has already positioned. Second, retail investor frenzy. When your barber, your Uber driver, and your relatives are asking about silver, the crowd is all in. Third, extreme bullish predictions. When analysts are forecasting $175 or $200 silver based on momentum and FOMO rather than fundamentals, that's euphoria. Fourth, physical premiums detaching from spot. When dealers are charging $15 to $20 over spot for silver eagles, that indicates speculative excess. All for warning signs are present right now in February 2026. Mainstream media is covering silver surge daily. Retail investors are piling in through ETFs and physical purchases. Analysts are making extreme bullish calls. Physical premiums have exploded. The setup looks like 1980. Now, does this mean silver crashes tomorrow? No. The 1980 bubble took several months to peak after these warning signs appeared. But it means risk is elevated and the probability of significant correction has increased substantially. So what should you do if you own silver right now? First, understand your time horizon and risk tolerance. If you bought silver at $30 and it's now $82, you're sitting on huge gains. Consider taking some profits. Lock in the win. Don't be greedy waiting for 175 if 82 is already life-changing money. Second, assess your position size. If silver represents more than 10 to 15% of your investment portfolio, you're over-concentrated in a single volatile commodity. Rebalance. Third, have a predetermined exit strategy. Don't wait for silver to tell you it's time to sell. Decide in advance. If silver hits 90, I sell half. If it drops to 70, I sell everything. Remove emotion from the decision. Here's what I would do based on historical precedent. If I owned silver bought below $40, I would sell 50% of my position right now at 82 and lock in over 100% gains. I would hold the remaining 50% with a stop loss at $70. This gives me participation if silver continues to 100, but protects me if it crashes like 1980. If I bought silver above $60 chasing momentum, I would sell everything immediately and accept small loss or small gain. The risk reward is terrible at current levels. Now let me address the bull case because I want to be fair. Silver bulls argue this time is different for several reasons. First, government cannot change futures exchange rules, like in 1980, because markets are global now. Second, industrial demand from green energy is structural, not cyclical. Third, central bank money printing is permanent, making silver's role as inflation hedge perpetual. These arguments have some merit, but every bubble thinks this time is different, and it never is. Fundamentals always reassert. Gravity always works. The historical lesson from the 1980 silver bubble is simple. Parabolic price increases driven by speculation and narrative, rather than fundamental supply-demand, always end in collapse. The only question is timing. Silver went from $6 to $50 over 18 months, then crashed 80% in 65 days. Today, silver has gone from 32 to 82 in 12 months. The pace is similar. The psychology is identical. The outcome will likely be the same. Here's my prediction based on historical pattern analysis. Silver likely peaks somewhere between $85 and $100 in the next 3 to 6 months. Then it corrects sharply, losing 50 to 70% of value over 6 to 12 months. We'll likely see silver back at $40 to $50 by early 2027. This is a crash prediction based on hope or bias. It's a pattern recognition based on historical precedent. And financial history doesn't repeat exactly, but it rhymes. The bottom line is this. Silver at $82 in 2026 looks exactly like silver at $40 in late 1979, right before the final manic phase and subsequent collapse. The inflation narrative is identical. The dollar weakness is identical. The speculation frenzy is identical. The supply deficit story is identical. The warning signs are identical. History is giving us a roadmap. The question is whether investors will learn from history or repeat it. Most will repeat it. They'll hold through the peak waiting for 175. They'll ride it back down to 40. They'll lose most of their gains. Don't be that investor. Study history. Use the pattern. Take profits when everyone else is buying. That's how you decode financial history and protect your wealth. Subscribe to this channel for weekly analysis connecting financial history to current markets. Share this video with anyone invested in silver who needs to understand the 1980 parallel. Drop a comment telling me if you own silver and what your exit strategy is. The conversation matters because those who learn from history profit from it. Those who ignore history repeat it. Stay informed. Stay profitable. I'll see you in the next video.